So what are we going to cover today? We're going to talk about what makes something. So let's look at some real world examples for childcare providers and then how you can maintain good record keeping, because I know that's always a big challenge. Uh-oh, okay. Now, let's dive into the foundation of today's webinar, which is really understanding what tax deductions are. Because as a childcare provider, you have lots of business expenses, and really understanding and knowing which ones you can deduct can save you thousands and thousands of dollars on your taxes every year. So we're going to break down what a tax deduction is now, why it matters, and then how you can distinguish between personal and business expenses. So a tax deduction is a legitimate expense that lowers your taxable income. So I know that was one of our poll questions, pre-check questions. So simply put, if you made $50,000 in revenue and you had $10,000 in expenses, your taxable income will be reduced to $40,000. So the lower your taxable income means the less you'll pay in taxes. So it's really crucial that you understand what these tax deductions are so you can maximize them and keep more of your hard-earned money in your pocket. Now, many childcare providers are overpaying in taxes simply because you're not taking advantage of all of the eligible deductions. So every dollar you deduct is a dollar you don't have to pay taxes on. And let's say you're in a 20% tax bracket. If you deduct $5,000 in business expenses, that saves you about $1,000 in taxes. So again, that puts that money back in your pocket and not in Uncle Sam's pocket. And some providers avoid claiming deductions because you might fear an IRS audit. However, deductions are a normal and necessary part of running your business. So, as long as your deductions are legitimate, they're well documented, and they follow the IRS guidelines, you will have absolutely nothing to worry about. In fact, not claiming your deductions you're entitled to could mean you're overpaying taxes unnecessarily and also heightening your risk for audit. Many people don't know this, but the IRS has what they call audit guides. And not only does it look at particular industries, but it also looks at regions. So if it sees that your income or your expenses are kind of out of alignment with other businesses in that area, it may call your return up for question. Now, the IRS has three criteria they look for when it comes to deductions. First, these expenses need to be ordinary and necessary, meaning they are common in your industry and you need them in order to run your business. Two, they need to be directly related to your business, and they must be properly documented. So this means keeping good records of all your expenses to back up your deductions is going to be crucial in case of an audit. Now, one of the most important things to understand is the distinction between personal and business expenses. So only business expenses can be